The era of cheap, easily accessible capital has ended. Rising interest rates and geopolitical friction have fractured the global investment map, forcing wealth to concentrate in deep, highly strategic pools. As this map shows, global foreign direct investment volume contracted by 11% in early 2024. But that contraction masks a structural reallocation. Right now, $1.5 trillion is actively moving across borders into technologically advanced hubs. This movement is dictated by three specific mandates: the integration of artificial intelligence, the China Plus One supply chain shift, and the global energy transition. Navigating 2025 requires ignoring historical geographic loyalties. Instead, investors are evaluating the top 10 sovereign markets based on their true risk-adjusted returns. The United States remains the preeminent anchor. Federal incentives from the CHIPS Act and a deep venture capital ecosystem are drawing capital into semiconductor fabrication and artificial intelligence. That environment captured $279 billion in foreign direct investment in a single year. But operating here means navigating a system where federal debt exceeds 120% of GDP, and political polarization creates significant policy uncertainty. Across the Pacific, Singapore operates as the financial and logistical fulcrum of the Asia-Pacific region. It offers absolute institutional stability and a safe harbor for wealth-fleeing tensions between the West and China. The city-state attracts corporate capital with 0% capital gains and a 17% corporate tax rate. However, managing domestic housing inflation is a priority, resulting in a punitive 60% stamp duty on foreign residential real estate. Both nations offer stability for technological and financial assets, provided investors can absorb the exceptionally high operating costs and commercial rental rates. India's appeal is built on its demographic dividend. The government is utilizing production-linked incentive subsidies to catalyze domestic manufacturing in electronics and pharmaceuticals. While India is on trajectory to become the world's third-largest economy, ground-level execution is difficult. Bureaucratic red tape and court backlogs mean contract enforcement can take over a decade, requiring rigorous international arbitration. The United Arab Emirates provides a blueprint for tax-efficient wealth synthesis. The market is generating gross residential rental yields as high as 10%, supported by zero property tax and zero capital gains. In Southeast Asia, Vietnam has established itself as the definitive hub for the supply chain diversification strategy away from China, specifically in electronics assembly. The state offers extensive tax holidays to attract factories, though rapid industrialization has strained capacity. Investors face a fragile electrical grid, structurally prone to blackouts, and a regulatory environment where licensing remains opaque. These three growth engines offer the highest growth projections globally. To capture them, capital allocators must bring specialized local expertise to navigate structural friction. Germany is navigating a severe structural transition. The state is deploying its AAA fiscal firepower to subsidize the reindustrialization of the nation through gigafactories and green hydrogen. Yet the loss of cheap pipeline gas has permanently elevated industrial energy costs. When combined with rigid labor laws and a demographic cliff, energy-intensive manufacturing struggles to remain competitive here without government grants. Canada relies on its critical mineral base and tariff-free access to the United States to draw capital. Long-term returns, however, are weighed down by a chronic productivity gap and environmental assessments that can delay mining projects for years. The United Kingdom remains the preeminent financial and fintech hub of Europe. It offers absolute legal predictability and a policy of full expensing, allowing companies to deduct 100% of machinery investments from their taxes. These legacy economies are relying on targeted subsidies and tax credits to retain global capital while they attempt to solve underlying demographic and productivity challenges. Mexico is the primary nearshoring arbitrage play. Manufacturers are moving supply chains out of Asia to utilize Mexico's labor costs and USMCA access, though operations face security risks from cartels and a shifting judicial landscape. Further south, Brazil acts as a green commodity superpower, leveraging an energy grid that is already While high interest rates provide strong returns for fixed-income investors, the Custo Brasil, a mix of complex indirect taxes and heavy labor litigation, drains corporate resources. These Latin American titans offer outsized geographic advantages. Generating those returns requires isolating and pricing in the region's systemic domestic risks. Capital deployment in 2025 is about aligning a specific strategy with the correct sovereign matrix. No single nation is the objectively right choice for every investor. For portfolio liquidity and AI development, the United States remains the primary destination. For tax-exempt real estate yields reaching 10%, capital is moving to the UAE. Industrial production is concentrating in Vietnam and Mexico. Meanwhile, the legal frameworks of the UK and Singapore provide the optimal base for scaling startups into European and Asian markets. Equally important are the red flags. Foreign capital is effectively barred from Canadian residential real estate through 2027. Without state subsidies, German heavy industry loses its edge, and the Mexican energy sector faces unacceptable nationalist contract risks. The $1.5 trillion reallocation of global wealth is targeted and unsentimental. The capital is moving. The only question is where your strategy fits on the sovereign ledger.